It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at Token 2049.
Welcome back to Real Vision. I'm Ash Bennington, joined today by our Real Vision favorite, Cem Karsan. Cem, pleasure to have you with us.
Great to be here.
Cem, our first conversation together, I've been listening to your take on markets, very sophisticated, very nuanced. Big picture, where are we right now? Look, obviously, everybody's watching this market, just red hot ripping equity markets. S&P 500 up year to date, almost 18%. NASDAQ composite up nearly 25% year to date. Lots to talk about, lots of market structure issues. Big picture, Cem, how do you see what's happening right now?
Well, I mean, you can't talk about right now and what's going to happen this year without talking about, the big seven and breadth broadly. We have a structural environment that people are likening to 2017 now, 2-3 months after we've talked about, hey, we're entering a period of massive vol supply. 2017, for those who aren't familiar, for most people, it was a very boring year. But if you're in the vol world, it was a historic year. In 125 years of market history, it was 30% lower realized volatility in 2017 than any other year in history. So a dramatic outlier. It was also 20% lower correlation between underlying constituents than any other year in 125 years of history. How does that happen? How do you get an outlier like that? Something is different. Well, what was different? We have the introduction of huge supply of volatility at the index level. Now it's in structured products. Then it was in a lot of products and funds that were selling iron condors and other vol things that eventually spectacularly imploded in the form of XIV and the vol apocalypse in 2018. This time, it's a little bit different because it's not concentrated and it's not really focused on retail. This is a widespread phenomenon. Basically, people are looking at the market and saying, hey, I don't know how I feel with this structural inflation about investing in the S&P 500 for the next 10 years. Maybe I'll go do some structured products. Maybe I'll do things to get a similar yield now that interest rates are higher and I could stack a yield. And so that structured product demand is really driving a lot of vol supply and recreating that dynamic. And that's the primary driver also of this dispersion. We're seeing 4 times the volatility of the single list constituents of the index than we are of the index itself. And that's because that vol supply is at the index level. We are pinning vol in the market. And when you do that, there are structural phenomena, which we can get more into detail later, which force consistent buying in the market day after day after day. If the market is pinned and interest rates are at 5.5%, there's skew in the market. You're going to get a consistent buyback in the market. And that's what we're seeing. We're seeing a dramatically pinned market with consistent grind higher. And that's likely to continue at least through the end of the year.
And this is really right to the core of what's happening right now. Such important points you make. I want to just peel the lid off and explain this to folks so that they can really understand what's happening here in markets. To your point, by the way, just some quick stats. S&P 500 year to date up about 17.5%, as I mentioned at the top of the show. S&P 500 equal weight up under 4% year to date. It gives you a little bit of a snapshot of how concentrated the market is, dispersion, breadth, all of those points. One of the things that I think people struggle to understand is the way most of us learn this in school. You have individual companies that post performance, they have revenue and earnings, and the stocks get priced on a price to earnings ratio basis on that. And then you have the S&P 500, allegedly the largest 500 companies in the market, and it's a snapshot of those 500 companies. But what we wind up with is this strange tail wagging the dog phenomenon, where you have the participation in the index, in the structured products, zero DTEs. I mean, all of this stuff that happens in markets that most people who don't have the background that you do as a trader just don't understand and don't know enough about. Walk us through the way markets really work, how price action at the index level and at the individual stock level is impacted.
So the index nowadays has more volume and more trading than the actual constituents. I think that's important for people to know. And when I say that, it's not just the futures, it's not the index, just the index itself. It's not just the ETFs, it's all of the derivatives and structured products and everything else that's tied to those indexes as well. And when that's the case, it's not the tail wagging the dog, it is the dog. The S&P 500 is the dog. That's what everybody's trading. That's what everybody's benchmarked against. That's what everybody's hedging against. That's where the majority of the trading and the positioning is. The constituents then have to fall in line with what is happening in the dog. The parts of the dog must equal the dog. And at the end of the day, if that dog is been put to sleep, right? If there is enough structured product demand where parts of the distribution are being sold and in such supply that the banks, the market makers, everybody else who is warehousing that positioning has to cause the dog to continue to sleep. The dog's not going anywhere. You can have parts, move one way or the other, but at the end of the day, the dog can't go. So let's talk about that in more detail. What do I mean by that? If Nvidia, this is the best example I can give recently, right? Nvidia beats earnings, right? And it jumps 10%. But it is, let's say, 5% of the S&P. That should mean the S&P, barring anything else changing, should be up 50 basis points, 0.5%, right? But what happened on the day that Nvidia beat earnings? Because of all that vol supply, Nvidia went up 10%, but the market went nowhere. And what does that mean? How does that happen? That means by definition, something else, the other in the 499 names, in aggregate, they have to go down 50 basis points to make up for that.
Just mechanically.
It's mechanical. It's arbitrage. It is full. It is by definition, it has to happen. And that is why, going back to that 2017 example, and this is why those two things are so intrinsically tied, correlation, right, and dispersion are tied together. At the end of the day, if the vol in the market is pinned and going nowhere, you still have idiosyncratic risk. If news still affects single list stocks, which it will because those aren't the vol centers, right? If some piece of news happened where, hey, this company found a cure for cancer, or this company like Salesforce massively missed their earnings, one's going to go up, one's going to go down, right? They're still going to have fundamental flows that force them in a certain direction. If that happens, and the index has been by definition, correlation has to go down. It has to go down. You have to have things moving away from each other. And that actually increases, ironically, it's very counterintuitive, but it increases the volatility of the constituents net. Even though the vol supply at the index level is pinned, and the VIX as a number, people may be saying, look, the vol of the index, we're not going anywhere, nothing's happening, but under the hood, you're actually oddly getting more volatility. And that has to happen. That is an arbitrage constraint. And that's very counterintuitive for people to think about, but the structural effects of the market force that to be the case.
Yeah, sort of another counterintuitive point that makes me think of is this idea of when you have a volatility that is nominally or arbitrarily suppressed, that you eventually what you have is increased volatility happening beneath the surface. So it's almost like periods of steady increases in price where you see a flattening of downside volatility. You're actually increasing the risk, almost like a tectonic plate underneath the surface. Talk a little bit about that idea.
Yeah. Look, at the end of the day, it's just like malinvestment. If you keep interest rates low enough for long enough, right, eventually it causes a bigger problem, right? And with volatility, if you compress that volatility, not only are you getting more realized volatility under the hood, so things moving in more dramatic ways under the hood, so that can break things. But eventually, you're also creating, and this is important in this instant, more malinvestments, more people coming in and saying, "Oh, this is an easy." My models say this is a sale. This is easy from a realized to implied basis. The best time historically to sell vol is when it's low. And so where are they doing that? They're doing that going and speculating in zero DTE. This is what happened in 17. It didn't start as a retail phenomenon, selling this vol. They were funds selling it. They were iron condors and well-defined risk ways. But eventually, people are making money. People see that opportunity, are willing to take more and more risk. If the market's not going to move, and it looks like it's not going to move for some time, they'll sell more. That's what's happening in zero DTE. It's such a free lunch every day. You come in, you sell that zero DTE, you walk away with a crazy sharp ratio, and it has been such a great trade for years now that ultimately it creates a false sense of security, and so people are selling a lot of this. But and what it's doing is reinforcing that vol compression again. It's a loop, but at some point you get concentrated risks. Somebody's taking too much risk relative to their balance sheet, whether it's long-term capital in 98, 97, whether it's XIV in 2017. Eventually, the profitability of something drives greater and greater risk. It creates models that essentially tell you, okay, you can take this amount of risk when really it's too much. And then all it takes is something to tip over and in one part of the market that's too big in a concentrated way. And then things start to wobble. And then the potential realized energy that then comes from that. You need that Minsky moment. So you can kind of see the sand kind of and the fragility kind of growing over time and the hollowing out of a castle. But as long as certain things are in place, it won't collapse. And then that last grain of sand, something happens, it becomes kind of too risky, and that tinderbox has been packed, and you get a volatile explosion. So it's almost always, I would say, always is a fair statement that eventually something going too far eventually leads to a dramatic move the other way in the pendulum swing. I think we're seeing that on a macro level from another perspective, but that's for a conversation for another.
You want to unfuck your shit? This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
So this is really just so interesting, and I want to stick with this and keep diving into it. I promise we're going to get Cem's take on what's happening in markets right now and what the near and intermediate and long-term outlook is that he has. But I just want to stay with this because it's so fascinating. You mentioned LTCM. For those of us of a certain age, that was the risk case that you learned in college or in your MBA program. But even more to the point, I think for where we are right now, in terms of the current market structure, you mentioned XIV. This is the inverse VIX that spectacularly collapsed. This is probably a great case to walk people through how this works, because it really has a little bit of everything there. It's the indexation. It talks about, it speaks to how market makers work, the structure of the options market, and how those fragilities build up in markets. Walk us through that and tell us what the lessons are today for the collapse of the XIV ETF.
Now, again, I want to reiterate, this is not the same exact environment in that regard. That was a vehicle that those that were in the know was bound, had structural faults, and it was bound to implode at some point. We can get into all those details. I think that would be a long conversation. But I think the important part that does rhyme here is the way that this will be undone, similar to 2018, resolving 2017's vol compression, is from a concentrated entity, right, that is over leveraged. And again, I think that's what rhymes between long-term capital management and XIV. Eventually, again, think about 1997. Long-term capital management's implosion was a function of the Asian flu, right? The Chinese, the Asian crisis. Eventually, that led to the Russian ruble default, and eventually wobbled enough and caused enough losses in the short term to begin an unwind of a concentrated position that was too big in long-term capital management, which eventually led to another market run and an dramatic, historic increase in volatility. What we saw in XIV's implosion was an over-concentrated entity again, right, with too much leverage that itself that broke its own pin, right? And ultimately, they had to stop issuance in XIV's case, creation of the shares that created a flight and a price break that eventually squeezed people out and broke the XIV. And ultimately, that same situation is bound to happen. The question is, where is the leverage? Who's holding it? And are we at a point where people are taking too much risk? And where is that concentrated? I think this time it's in zero DTE. The question is, who is the entity or what are the entities that are most at risk there? We can get into why that is, and it's generally tied to a structural fault, meaning it's too big relative to to its size to accommodate the amount of impact that can happen in a short period of time. We can dive into that.
Yeah, let's talk about that. Let's unpack it for people who are just trying to get their heads around it. By the way, one of the interesting things about LTCM is just a historical footnote. Is one of the reasons why that story is so powerful was because they had not one but two Nobel Prize winning economists working at that hedge fund, John Meriwether and Myron Scholes of the Black-Scholes model, which we'll probably discuss at some point today. But it just gives you some indication of the degree of complexity and how difficult these things can be to predict and understand ex ante. But let's talk a little bit about ZTEs. First of all, let's walk people through what zero DTE are, what their intent was, and how they're being used today.
Yeah, zero DTE options are simply options that expire in one day. They have 0 days to expiration. They're being listed on the day of their expiry or being traded on their day of expiry. Why have they become popular? Well, that's a complicated question, but in my opinion, from our research, it's a function of normal options, regular options, originally not working so well in the context of a market down, vol down phenomenon. When people were hedged in 2022 and the market declined 25%, implied volatility or options that are longer dated did not perform very well. So you had significant losses. Definitely, the hedges did not broadly work as people would have expected in 22, and that's happened again over different periods. But that was a function of people being hedged. 2020 happened. All the vol sellers blew out. Everybody who expected a decline was hedged for that event in 2022. And what that ultimately did was created a vol compression, a vol supply into that decline. Once that happened, entities started saying, listen, I'm tired of betting on whether insurance for a downturn goes up or not. I just want to bet on the actual event going down. And the way to do that specifically is to buy the daily options, have almost no vega to them, right? No implied volatility. They're primarily a bet on, they're almost pure gamma. They're almost a pure bet on a directional move and a leveraged hedge. That started the whole process of hedging with these. And this was not just individuals betting on them, which we heard a lot about, and speculating on calls or puts for leverage. That was part of it. But this was actually institutions daily coming in and buying these things to hedge because they were getting much better hedges with these than any other thing. So at first, right, that was, again, in 22, 23, it was performing well. Well, eventually what that led to is entities who were providing the supply of that, mostly market makers, but also some banks, saying, okay, well, we're going to keep lifting the prices because we can't hedge this amount of gamma. It's too hard. And eventually these things are circular. Because those prices got so high, they were increasingly losers and just as expensive and hard to hedge, hard to hedge with. Eventually, there were a lot of sellers who came in and started realizing this can be a very profitable place with a lot of realized edge to sell. It's become so profitable on both sides over different periods that it's created a little microcosm, right, of trading. And it's become a place for regular speculation. There's now a balanced amount of buyers and sellers and a significant amount of trading that's happening. But again, the key point here is that it's a much more direct way to bet on realized volatility as opposed to implied volatility. And I know that sounds like similar things and confusing. Implied volatility is the actual insurance contracts themselves saying, hey, will this insurance contract go up or down in value? When there's tornado comes through town, if you have tornado insurance, it's not just whether or not your house got hit by the insurance that matters for that hedge. What matters also is what are people willing to pay for that tornado insurance at that moment? And so that can lead to a lot of variability in the performance of hedges, which has been very frustrating for people who don't understand these options as well. And these zero DT options have allowed people to more directly focus and bet on what happened in the outcome and not what's happening to the value of the insurance itself. Hopefully I didn't lose people there, but I think that's an important distinction. And zero DT has become 40% of the volume of the options in the S&P 500 now.
Well, let's explain this to people and walk them through it, because I think that there are a lot of people there who may have had their brains melt a little bit trying to walk through that. But I think that there's also a sense when they see these very large moves that don't seem to be correlated to any fundamental events happening in markets. They understand that there are market dynamics that are at play that are not necessarily transparent to retail investors. Let's walk through some of the foundational knowledge that people need to understand your last answer. Let's talk a little bit about gamma, which is this idea of the change in the price of the options contract relative to the change in delta. Let's explain this to people from the very beginning, because there's a significant role, obviously, that market makers and other intermediaries have as they try and balance that out, and they have positions that they need to hedge against. Let's explain that to people from the very sort of entry-level option strategy perspective.
Sure. I think that's important. So let's not talk as it relates to zero DT specifically yet. Let's just talk about an option, right? An option, if you're buying, let's say, something that's significantly out of the money, meaning not near the at the money, but out of the money, either on the call side to the upside or the put side to the downside. On either one of those, if you're buying something out of the money, the probability of it being in the money or being worth something at expiration is quite low, right? By definition, if it's out of the money, it may be a 10% probability of being, right? A 10 delta means it more or less has a 10% chance of being in the money. In order to hedge that, in terms of delta, the market exposure at that given moment, if I'm buying a 10 delta call, I need to sell 1/10, 10% of an S&P future contract or the S&P index, right? The problem with that hedge is that if I am selling that, or that delta, that probability changes whether I'm buying or selling it. If the market goes up, the probability of that being in the money goes up. If eventually you get right to that strike, then it's a 50 delta, has a 50% chance of being in or out of the money, right? So this is what creates leverage, as people call it, in option, right? Because if I have a 10% probability of something and then all of a sudden it becomes 50%, I have now increased my directional bet by 5 times, right? That change in that delta from 10 to 50 is gamma. The change of your delta is your gamma, right? And what drives that is this optionality, right? This probability change of options. Now, gamma goes 2 ways. We could also move away from it. That 10 delta, that 10% probability, if the market goes down, if it's a call, could go to 1 or to 0, right? Now, if you're hedging this, which is what market makers and banks are doing, people who are warehousing this risk, right? That they have to re-hedge that gamma at some point, right? To stay balanced in their positioning. And so if dealers are massively long gamma because they're being sold these options and they're buying them, right? If the market goes down, they need to buy. And if the market goes up, they need to sell because they're making money in either direction. And the reflexive effects we've talked about pinning of the index. We're saying right now, the market's not moving, right? Because there's all this vol supply. That's what I'm saying. The market is long all of this gamma. Everybody warehousing the risk, dealers, market makers, funds that are selling vol. All of them are long that gamma. The opposite is true. When the market gets short gamma and dealers get short, market makers, banks get short, they now have to do the opposite. The market goes up, they have to buy. If the market goes down, they have to sell, and that increases volatility. So when this vol supply on the market is very important because it reflexively creates either more volatility or less volatility as a loop, right? Now, to zero DTE, that gamma, right, is biggest. When is it biggest? It's not biggest, 2 years out. Why? Because 2 years out, if the market goes up 5%, the probability of that call being in or out of the money doesn't change that quickly. But the probability of an option with zero DTE being in the money or out of the money can change in a second. If the market goes up 10 points and something 15 points out of the money had a 10% probability, now it may have a 50 delta, 50% probability very quickly. And those dramatic changes are very hard to hedge with the underlying index. In fact, at RMC, which is the SIBO's risk management conference last year that I attended, they had market makers on stage, and we were all talking, asking questions. And those market makers said what I've known all along, both of them, which is they don't hedge these zero DTE options with futures or underlying because they can't. The gamma is just too much. They have to hedge zero DTE with zero DTE, which creates a reflexive loop, right? That works well as long as there's two-sided supply. But if a big enough order comes in where everybody in zero DTE gets totally swept out of their gamma and becomes short gamma, now you have a cascade, right? Where everybody is trying to get back that same hedge with the same trade. And that's why I think zero DTE ultimately will be a significant force in the next decline or increase of volatility that does happen.
So this is really interesting, and I want to talk a little bit about how everything you just said bears on the current dynamics of this market. Look, Cem, I know just enough to be dangerous here, but it's pretty clear to me that we've seen this pattern, obviously, of when you look at the chart of U.S. equity markets, you look at the historical rate of return on these indices. You look at where we are today, roughly halfway through the year, obviously blowing through the historic rate of returns, significantly outperforming. You do have to wonder at what point this might be getting a little bit off sides. Let's talk about what some of those risks might look like going forward.
So we mentioned long-term capital management, right? And I think that's the one that's that rhymes the best here in this current circumstance. Yes, times are different. We have a structural vol supply, which didn't exist back then. So, you have to think about how 2017 into 18 kind of that environment with vol supply kind of dovetails into the macro picture of 97. But it rhymes to me because we had a similar situation where essentially the Fed was increasing interest rates. The value of the dollar was very strong and causing all kinds of problems from a macro perspective from emerging market economy. We're seeing that same thing right now, right? And I think that itself, macro, in my view, will eventually, especially some corner of macro, maybe it's the yen, right? There's a lot of talk about what's happening in Japan right now. Maybe it's China and the yuan. There are lots of places that they're feeling a lot of pain and seeing a lot of outflows as a function of higher interest rates in the U.S. relative to the rest of the world. And that dollar strength and weakness in those currencies is a big potential issue. It's creating a lot of stress in little corners of the world. Now, again, that created, this is a different time than 97. I get it. It's not going to be the same exact thing, but those rules still apply. And if we continue to go down this path of dollar strength, I think that could be something that really eventually creates emerging market problems in other holdings and banks that eventually could cause a ripple effect and increase volatility in a part of the market that creates a wobble, right? Something that unpins this vol. And when you do unpin the vol from, it's like dropping something from a higher altitude. There's just more room to fall. There's just more potential realized volatility. With implied vol this low, if there's a concentrated bet, if something blows up, eventually the tail is just going to be fat. And that's what we're in. We're in a very tight distribution in terms of the actual volatility and the odds of something happening. But if something happens, it is going to be a fat, big left tail. And so that distribution of outcomes is very different. That said, I don't think we're there yet. And there's structural effects in place that make that pin and volatility so strong right now that into the end of the year, there's also reflexive effects, especially as we start to get closer and closer to the end of the year, that reiterate this momentum, that reiterate the vol supply, that keep this thing going in the same direction. That said, seasonality breaks, vol supply weakens, all of a sudden something wobbles, and you can get a real big impact event out of nowhere sometimes.
So let's talk about what that wobble might look like. Listen, if there's one thing I can assure you of, it's a hell of a lot easier to ask these questions than to answer them. But I have to say, when I asked you about the current market dynamics, the first 8 words out of your mouth was, so we talked about long-term capital management. Boy, that is a sobering way to begin anything when we talk about where markets are today. I should say, just for a little bit of context here, dollar yen right now trading at 161 on my screen. It hasn't been at that level since I could run a mile without wheezing. It's been a long time, 1990s, I think, since we were at these levels. When you look at these markets, when you think about where these fragilities might lie, what are you looking for? What are the gauges on your screen that you're looking at to see if one of these wobbles starts to begin? Because boy, if you can find that wobble before it becomes a full out spin, it's really obviously a significant advantage for investors.
Yeah, I think the key when you're looking at these things is, I think everybody's looking for, well, what level are you looking at? Because people are very directional, right? And what asset? And that's not what I'm going to tell you. What you're looking for is speed. Is about the volatility and acceleration of certain different factors, right? If volatility or the way things break is things don't break slowly, right? Things break when the acceleration starts. When you start to see an impact of an event that is too big and too fast for an entity to manage anymore. And so the speed and acceleration, the acceleration, the gamma, if you will, right, the second derivative of the move, is ultimately the thing that you really, really want to be paying attention to. And you want to do that. You want to look at that as it looks as you see flows in emerging markets, right? What's happening to outflows in these countries? You want to see it in currency and FX pairs. You want to look at interest rates, particularly short-dated interest rates, and what's happening at different points. We in the volatility markets look for, I've told people this before, but in terms of high frequency data, that's very important. The ultimate fattest, the only way you can hedge the fattest tail is by looking at VIX calls, which is the most convex moment, or really, really close, 2, 3, 4, 5 days out, really small units, nickels, dimes, 15s. That's the way to get the biggest leverage. When those things start to break, that's you have probably hours, if not a day, right? So these are things to look at. Those, on the macro side, really looking at, again, FX pairs, as I was saying, fundamental outflows and problems on the governmental level. When derivatives contracts and volatility of those contracts start to break is a very good sign that you really want to dive in. And then again, across indexes in the most liquid markets, those fat tails, when those start no longer being available for hedging, that's usually a sign that the convex moment is happening and can accelerate very quickly from there.
Yeah, I guess the flip side of that question, it's an important point to make it by way of disclosure, is that to borrow from Keynes, markets can stay irrational for very long periods of time. And so there's no implication here that something is imminent. So let's talk about
Quite
that.
the contrary. I want to be clear. I didn't come on here to kind of scare people, right? This is talking about distribution. And as I mentioned, this distribution is very tight. And this is a highly profitable time to sell volatility. Historically low volatility like this begets more volatility, and the risk-adjusted returns of that realized versus implied is actually wider during these times, despite the implied volatility being quite low. And that's for a reason. The structural effects are in place. People realize it in the short term, and they're going out and they're making those bets, which is reflexively making those bets more likely. So I'm not telling you to go out and buy hedges right now. What I am saying is that when the tail event happens, it's a low probability, high impact event, and it'll be much higher impact than anything we've seen other than, let's say, the biggest ones like XIV or long-term capital management or something along those lines.
But what's interesting to me and is fleshing out this idea of XIV affected a very small group of people who were speculating in that. What is the risk to broader markets if you do see this snapback moment? Because we're talking here about things that are implicit in the broader market structure that are extremely widely owned. We're talking about a handful of stocks, half a dozen or thereabout, that have seen tremendous increases, dramatic increases in market capitalization relative to the equal weight on the index. What's the risk if this scenario begins to unfold?
Yeah, again, not to put all this bear porn out there, but I think the reality is that we live in a very dangerous structural time. I've called this a sumo market before, right? What do I mean by that? If you have two things pushing on each other, right? And it's, let's say, two skinny little wrestlers, there's not a lot of potential energy there. Right? But next to them, on the mat next to them, there's another wrestling match going on with two sumo wrestlers. They may not be moving either. They may be pushing on each other. But there's much more potential energy. There's much more likely to be something very volatile that happens. Once those guys slip on the sumo mat, you're going to see bodies flowing in dramatically different directions. We're at a balance here because of structural flows, but the underlying pressure in the system is dramatically higher than we were, let's say, in 2017, right? And the reason is because we have a situation where structurally we're having political changes globally, we're having deglobalization, we're having global conflict, we're getting higher interest rates, right? We're getting commodity scarcity. All of these are a function of a bigger macro picture, which we've talked about on this show and other shows at length, that are driven by structural effects, generational divides, inequality, and a lot of other big picture things. Those structurally higher interest rates, that structural inflation, and the protectionism and populism that's driving it, ultimately create a much higher potential energy environment. When things break here, the probability of them breaking big are much higher.
Yeah.
And I think that's the thing that people aren't appreciating, that the realities and the fundamentals, they matter. They always matter. They may not matter this 6 months. They may not matter this year. They may not matter for 2 years. But in the long run, they always matter. We knew, for example, that the housing crisis was coming. Everybody knew that. We were talking about it in 2005 and 2006. It just took way longer than people expected. And then it eventually imploded, right? We knew that NASDAQ was overvalued and that it was a bubble. Everybody knew that. We're talking about it in 98, and then it doubled. It didn't change the fundamentals and the realities of underneath the market. We know the risks here and the problems underlying. Most people do. We talk about this all the time. That doesn't mean in the next 6 months or the next 9 months that it's going to implode. But when it does, the risks are significant. We are in a sumo market. There's a ton of potential energy, right? And that's reiterating, by the way, this dispersion. The dispersion, we talked about it from a structural perspective, right? What's driving this dispersion? But part of what's driving it is also these underlying volatile dynamics that are really pushing idiosyncratic risk across the market in different directions. It's just being held together, right, by all of these flows. And so again, fat tail always, as we talked about at the beginning, as volatility goes so far one way, eventually it undoes itself. But this time when it undoes itself, all the structural volatility, all the structural flows, of lower interest rates, of all of of all the growth that's coming from globalization and technological development, all the things that we were seeing before are no longer there now to underpin things. And I think we could have a much bigger structural issue. The Federal Reserve, not to shift to macro all of a sudden, but the Federal Reserve is in a bit of a box. And that wasn't the case 5 years ago, 10 years ago. And I think that, which is the ultimate source of the biggest flows in a tail event, right, is a recipe for a much bigger structural problem.
Jim, here's the fascinating thing. I'm not a deep thinker about markets, right? But I can read the headlines. I can see what's happening in elections in Europe. We could talk about structural causes of inflation. We could talk about all of the geopolitical risks. We could talk about the risks to commodities on a supply side shock. We talk about the risks of a potential demand decrease when you have increased AI, increased technological innovation that drives out folks in the labor markets. Here's the really fascinating thing about everything we've just discussed. If I were to pull up a chart of the S&P 500 from, say, Halloween of last year and say, show me where you see those risks being priced in to asset market prices, it's just not on the chart. It's just not there.
And that's the whole point, right? At the end of the day, all that matters in the short term is the voting machine. It's supply and demand. And if there's structural effects that can put people to sleep, that'll just kind of create the machine going on about its own path, right? For some time, it will. We confuse the short term for the bigger picture. To be clear, the NASDAQ was overvalued in 97 and 98. We knew that. And then it doubled. And then it dropped 90%, right? And this is how the machine works. The natural state of things is for things to march higher, for volatility to become more and more compressed, for things to go to this final terminus where things are ultimately, again, that sumo market is so pressured that eventually the smallest thing, right? Butterfly flaps its wings somewhere. It drives that final straw and that final piece of sand to move, and then things start to change. And then the cycle goes the other way, much like I was expressing. Vol supply begets vol compression, begets vol support, buying support, which begets more vol supply, which is a full circle. But the exact opposite also holds true, which is once these things start moving the other way and volatility becomes unpinned, now the stress begets more stress. And so just because we're seeing an upward march in the context of all of these scary things does not mean that the scary things aren't valid. It doesn't, though, mean that those scary things are going to become a problem today, tomorrow, right? And this is why the flows, right? We're talking about big picture distribution, right? Fundamentals, and this is well documented, have zero correlation to market outcomes in any period less than 10 years. Right? This is why Shiller did his 10-year, right, PE, right? Because it matters over 10 years historically, right? It may not in 10 years, but historically there's a correlation. But over 1 year, 2 year, even 5 year periods, fundamentals have little to no correlation to the outcomes. Eventually they matter. Fundamentals matter. But the path to getting to those fundamentals can be completely, much like it was in 99, completely, unrelated in the short term to the long-term outcome. And the short-term markets are a voting machine. They're a supply-demand machine. You must understand those flows if you're betting on quarterly, monthly, quarterly, annual outcomes. They're all that really matter over that period. But if you're really betting for the long term, for the next 10, 20 years, yes, getting the big picture right is critical. It's everything. You just might go on a really wild journey on your way to that final outcome. And that's what the weighing machine is, right? This is what Graham calls the weighing machine. At the end of the day, the weighing machine wins out. Usually, that rebalancing happens in the lack of liquidity. Everything comes back in line when there's no longer liquidity. And that's what I suspect will happen here. into a decline, things will become more logical.
By the way, for those not familiar with the quote, this is the great Benjamin Graham quote. In the short run, markets are voting machines. In the long run, they're weighing machines. In the short run, they're popularity contests. But in the long run, they are ultimately about fundamentals. And the fundamentals ultimately do have an impact. And understanding that and balancing that really is the art and the science. By the way, which brings us to this great question from Andrew, who wants to know, what do you see the S&P 500 and NASDAQ doing for the next 30 to 60 days, next month or two?
So we said about 2.5 months ago now, about 2 months ago, in late April, early May, to expect what we called the summer of George. This is a Seinfeld reference. We've called for this before and been spot on. What is it? When vol supply is where it is at this point, right? Markets have a very, very hard time moving down. There is skew in the market, which ultimately forces a buyback of stock by dealers, market makers, banks, et cetera, every day. And it accelerates into expirations. And then when months are up and the market's up, then there's a buyback and a momentum releveraging effect that happens at the end of the month that then forces more buying. As we enter, throughout the summer when volatility is low, and less is going on, and people are in the Hamptons, at the beach, wherever they are, there's just less liquidity, right, to overwhelm this vol supply and these structural effects as well. So it was pretty clear to me coming in several months ago that we would see this. What have we seen in 2 months? We have not seen a decline in the market of greater than 0.5% for the whole 2 months, right? And corollary to that is dispersion. What have we seen? Historic dispersion. Right? Much like we talked about, those two things are bedfellows. If index vol is well compressed and the market continues to grind higher, dispersion is going to go to a record. So this is specifically what we called for 2 months ago. And I said 2 months ago that expect for it to last for 3 months. So we have until I put the marker on the board. People have circled it. People think I'm crazy when I name out specific dates, but August 14th, right? 13th, 14th, somewhere in that week, which is the week of August expiration, would be the time to start expecting volatility to have a higher probability of starting to come out of that extreme vol compression. So, don't step in front of a buzzsaw before then, right? That said, prepare for what is likely to come September, October, November. Now, my belief is that this is, if-then statement, right? Assuming that we continue to march down this path again for another month and a half, a month and a week now, what lays on the other side? Well, I'm not looking for a crash. I'm looking for an increase in volatility. In my view, that'll likely happen into a rally. And the way that these things unpin themselves is generally into a rally. It's counterintuitive. But there's skew in the marketplace, which means downside options are priced on a higher implied volatility than upside options. So naturally, if we continue to grind higher, options will get cheaper and cheaper on their own accord. Not to mention all the vol selling that is getting them to a point which is even cheaper. At some point, that vol just gets too low. And the acceleration generally in those things becomes on the upside. The realized volatility on the upside gets to be just too big relative to the implied volatility, which means it becomes profitable for entities to come in and start buying vol at these lower levels. Add to that, the vol supply is likely to dissipate a bit as we get into September, October, November. Why? We have an election sitting there in early November, right? There's already a lot of hedging that's happened out there, which has made dealers shorter out there. They're hedging it with shorter dated options. They're able to manage it and be still long gamma. But as we approach that level, that vol supply kind of dissipates because the positioning out there is already. Not to mention you have all the realized potential risks and all that volume comes back in September. People come back from the beach and all of a sudden, some of this vol supply just looks too cheap. And that can take dealers out of that vol supply. That can take market makers and banks out of that vol supply and start to create a reinforcing loop the other way. Now, just because that's likely to happen, in my view, it doesn't mean I'm looking for a crash in it. I do think increases in volatility will likely increase the volatility of the market, which means we're likely at that point to get declines of greater than 0.5%, right? We're likely to start getting some real volatility again. in my view, we'll get some type of pullback in that window. I would say sometime between mid-August, that date I gave you, and sometime mid to late, I'd say late September probably. We'll probably get in that window something. And that's a reason. There's a reason that volatility happens in those windows. The seasonality is not a magical construct. It's tied to these flows that I'm talking about. So if we do, again, I think it's a viable dip into the end of the year. Now, there's no insurance there. If it goes big enough, it will become a self-reinforcing loop. But the highest probability is that we get some type of wobble there. That's not too big. Call it 5, 10, maybe 10%. Right? But on the implied vols that we're on, and with vol increasing, that'll feel big, right? I mean, at these levels, that's a 500, 600 point, 500 point decline in the S&P. When that happens, I think implied volatility will stay elevated after that and start to go higher from these. When I say elevated relative to these levels, will normalize. And that vol supply, which took people out of, will change the characteristic and the distribution of the final leg of the rally, in my view, which will be into the end of the year. I think we'll get a continued rally after a pullback in the early fall. And I do think that rally that we see at the end of the year will be pretty dramatic from some lower level. Think a 500 point decline sometime in the late summer, early fall, followed by 1,000 to 1,500 point rally. I could see us going from 5,800 or so, 5,750, somewhere in this area. That we get to 100 points higher or 150 points higher from here, then declining down to 5,100 again, and then seeing 5,100 give up to 6,000 by the end of the year. Something like that, with volatility increasing into the rally, unpitting a bit, right, and accelerating at the end. That ultimately, I think, could be a really dangerous place early next year. That's our current view. Again, a lot of if-then statements. We've gotten them right 1, 2, 3, 4, 5 in a row. The first one is important in order for the second one to happen, which is that we continue to see, and it's the highest conviction one I have now, that this rally and this vol compression will continue in the short term for another month or so. But again, given that'll happen, if that happens, I would expect that being a opportunity to buy volatility broadly into a rally. So long dated calls are a great position to have out in September, October, November, December on out, and yet funding them with short dated options, right, and allowing you to not pay for those options and the decay of them until that time comes.
Yeah, it was just a fascinating conversation. I really enjoyed this, and you definitely have the courage of your convictions, picking dates, picking levels. Really appreciate you going that granular for us. It's just fascinating, and I hope I haven't gotten too carried away with the bear case here. I have genius for pointing out the obvious. Just looking at the current near 18% return on the S&P, outstripping the roughly, call it 10% or thereabouts over the last 65 years. Clearly, obviously, here only about halfway through the year. You look at that, you see some of the things that we've talked about, some of the structural risks, geopolitical, political risks, specifically here in the United States and in Europe, some of the rising structural challenges just not being priced into markets. Fascinating take, Cem, on the behind the scenes mechanics, how markets really work. Final thoughts, key takeaways, Cem, that you'd like to leave our viewers and our listeners with.
The last bit that I didn't mention is your average election a year during populist periods, which I classify this as, is about 22%. So your bogey is about another 4 or 5% from here. We believe that we will hit that, and it'll be close to in line, somewhere in that general area by the end of the year. The other reason, other than just historical precedent, is that up markets see big positive flows into the end of the year. We look at about $100 trillion of global equities, right, in the world. When that market is up 25%, that means $25 trillion of new collateral, new cash value. That wealth effect, as people call it, is very real. That allows for more capital, more investment. And those reinvestment periods for that leverage happen not every day. Some of it happens every day, but monthly, quarterly, and biggest of all, annually. So as you get into the end of the year, and if the market is up big, it is highly probable that people start trying to front run those flows that are coming in. If only 10% of $25 trillion, right, gets reinvested on January 1st, that's $2.5 trillion. That is a dramatic amount of flows that comes in at the end of the year. So again, we have a wobble likely coming here. If it doesn't undo things big enough, the bet will be back on into the end of the year. And if the volatility is unpinned, that lack of vol supply into that window will increase the volatility of the coming final round. So you really need to be thinking about these in this context. All the flows matter, but the vol supply and what the people warehousing the risk in the market are wearing are most important of all.
Cem Karsan, such a pleasure doing this with you. I hope you'll come back and do this again with us soon.
My pleasure. Would love to. Look forward to it.
Thanks for joining us. Thanks for watching. Thanks for listening. Have a great afternoon, everybody.
It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.